There are 5 levels of crypto wealth, and you're probably stuck at number 1. And in this video, I'm going to explain what each level is, where you're at right now, and what you need to do to move to the next level to build generational wealth. Level number 1, you could probably guess it. You're basically a gambler. This is where almost everyone starts. And unfortunately, it's where a lot of people stay for forever. You've heard about crypto from a friend. Maybe you saw it on TikTok or you watched someone, make a fortune overnight and you thought, I need to get into this. So you threw some money at whatever was pumping that week without doing any real research. There's not really a strategy for when you buy, no plan on when to sell, just hoping that the number goes up and you can cash out before it crashes. Most people enter the crypto space exactly like this, chasing green candles and hoping for the best. It becomes an emotional roller coaster. The gambler buys based on emotion, and the emotion is the worst trading indicator that you could possibly use. They see a coin pumping 50% in a day and think, I need to get into this before it's too late. And so they buy the top, and then it dumps 60% the next day, and then they panic sell because now they've lost all this money and they can't handle watching it go lower. This is a classic buy high, sell low pattern that destroys portfolios over and over again. Also, something else I see often for this group is they're chasing narratives instead of building positions. People in this level are always chasing whatever narrative is hot at the moment. AI coins are pumping, so they sell everything and they dump it all into AI coins. Then meme coins start running, and so they ape into those right before they dump. They're always one step behind whatever the market is doing, and by the time they get in, the move is already over. And they don't manage risk, which is one of the largest problems with this group. They have no concept of position size or portfolio management. There's no structure, no plan, and no way to manage the risks when they inevitably invest in something that goes wrong. So here's why most people stay stuck at this level. They treat crypto like a casino. They throw a little bit of money in, they hope to make a bunch of money in a very short period of time. They're not really investing. And if you go to casino, just like a gambler would, the house usually wins. Most people at this level lose money, not because crypto is a bad investment, but because gambling is just a poor strategy. Some get lucky once and they think they're a genius, and then they give it all back in the next trade chasing the same high. They cycle through the pattern for years, making money in bull markets and then losing it all again in bear markets, waiting for the next crypto cycle to begin. If you've been following this channel, you should be way past this level a long time ago, but I think it's important just for the newcomers in this space to understand where you're starting and where you're going. Level 2, the hodler. Level 2 is a big step up from level 1. And honestly, just getting here puts you ahead of most people in crypto. So what is a hodler? It's, a holder, but the L and the D are swapped. But in general, you've stopped gambling and you're holding these positions. It sounds simple, but it requires more discipline than most people have. You bought XRP or Bitcoin or XDC or ETH, whatever you have, but you've just held it through the volatility. The holder has one core strategy. Don't sell. No matter what happens in the short term, don't let your emotions take over, continue to dollar cost average, and eventually you'll make money. This doesn't always work though, because the market does drop 50, 70, or even 80% sometimes if you bought at the highs and you're just holding, waiting for the recovery. Now, over a long enough duration, this will work. The holder understands one big thing that the gambler doesn't, and it's time in the market beats timing the market. They understand that trying to trade in and out of positions ultimately just loses money because you're competing against algorithms and professionals. So they just sit tight, ignore the noise, and let time do the work. And honestly, this is the simplest strategy that works better than most active trading strategies out there. Most people that are trading, 96% of those people lose money because again, you are trading against professionals and algorithms. So for the average person that has, a day job or other things that they're focused on, this is probably one of the best ways to go about it. The problem with holding though is it's not real wealth building strategy, or at least not the most effective one. You're not actually doing anything to grow your position. You're just waiting for the market to do the work for you, which again, if you want to be passive, is a good way to go about it. Most holders watch their portfolio go up in bull markets and down in bear markets. And over a full cycle, they often end up roughly where they started, maybe slightly down, but they're not compounding their gains in a meaningful way. So what's the missing piece? Well, they don't have an exit plan. Their plan is, I'm never selling, which sounds great, but it's not actually a strategy. Now, if you understand that you're going to be able to borrow against these assets or put them to work to be able to generate cash flow and compound them, it's a different story. But not having diversification, no risk management, and putting full faith that an asset's just going to go up for forever, probably not the best way to go about it. And the problem here also is when you do cash out at some point in the future, if you're not borrowing against it, like we talk about here on this channel, probably going to have a significant amount of taxes that are going to be due. But if you're trading all the time, you're going to have those taxes due anyway. So you want to make sure that one, you've either structured this in a way like an IRA or another product where the taxes are deferred, or they are, risk tax free if you're in a Roth, or you're doing it inside of a life insurance policy or an endowment or some other structure that mitigates taxes. Or if you are doing it in your personal name, ideally you're going to move it into a trust or an LLC so that you have at least the full breadth tax code at your disposal to be able to offset some of those tax implications that you're going to be incurring when you do inevitably sell a portion of your bag. So how do you actually move